Bonds are often overlooked in the world of investing, but they can play a powerful role in securing your financial future. Whether you're saving for retirement, building a steady income stream, or looking to balance risk in your portfolio, bonds provide stability and predictability that other investments can't. In this video, we'll explore how bonds work, the different types you can invest in, and strategies to make them a cornerstone of your financial plan. If you're ready to take control of your future with smart, low-risk investing, this is the perfect place to start. Today, we will talk about how to use bonds to secure your financial future. So before we get started, make sure to hit that like button, also subscribe to my channel. Did you know that one of the safest ways to build wealth and secure your financial future is often overlooked by most people? Bonds may not sound as exciting as stocks or real estate, but they are a cornerstone of smart financial planning. What if I told you that bonds could be the key to steady income, low risk, and financial peace of mind? Stay with me until the end of this video, and I'll show you how bonds work and how you can use them to build a rock-solid financial foundation. What are bonds? Let's start with the basics. Bonds are essentially loans you give to governments, corporations, or other entities. When you buy a bond, you're lending money to the issuer in exchange for regular interest payments over a set period. Once the bond matures, the issuer repays the initial amount you invested. Bonds are often considered one of the safest investment options because they provide a predictable income stream and are less volatile than stocks. But not all bonds are created equal, and understanding their different types is crucial to using them effectively. Types of bonds. There are several types of bonds, each suited to different financial goals. Let's break them down. Government bonds. Government bonds are issued by national governments to fund various public projects. They're considered some of the safest investments because they're backed by the government. Examples include U.S. Treasury bonds, which are highly stable, and municipal bonds, which are issued by local governments. Corporate bonds. These are issued by companies to raise capital for business operations or expansion. Corporate bonds usually offer higher interest rates than government bonds but come with slightly more risk, depending on the company's financial health. High-yield bonds, often called junk bonds. These offer higher returns but come with higher risk. They're issued by companies with lower credit ratings and should be approached cautiously. Savings bonds. Savings bonds are typically long-term investments with lower returns but guaranteed safety. They're a good option for conservative investors looking to preserve capital. Inflation-linked bonds. These bonds are designed to protect your investment from inflation. Their interest payments adjust based on inflation rates, ensuring your purchasing power isn't eroded over time. Why should you invest in bonds? Bonds offer numerous advantages that make them an essential part of any financial strategy. Stability. Unlike stocks, bonds are far less volatile. They provide a steady income, making them ideal for risk-averse investors or those nearing retirement. Diversification. A well-rounded investment portfolio needs a mix of asset types to balance risk. Bonds can act as a counterweight to the volatility of stocks, smoothing out your overall returns. Predictable income. Bonds are one of the few investments that offer a consistent income stream through regular interest payments. This makes them perfect for those looking to supplement their income. Preservation of capital. If protecting your initial investment is a priority, bonds are a great choice. Many bonds guarantee the return of your principal, making them a safer option than stocks. How bonds fit into a financial plan. Bonds aren't just for retirees or conservative investors. They can benefit anyone looking to secure their financial future. Here's how bonds can fit into different stages of your financial journey. Young investors. For younger investors, bonds can provide stability in an otherwise aggressive, stock-heavy portfolio. While stocks may dominate in this phase, a small allocation to bonds can act as a safety net during market downturns. Mid-career investors. As you approach your peak earning years, you'll want to start balancing growth with security. Adding more bonds to your portfolio can reduce risk while still allowing for some growth. Retirees. In retirement, your focus shifts from growth to income and preservation. Bonds become a critical component of your portfolio, providing a reliable income stream and protecting your wealth. How to choose the right bonds. Not all bonds are the same, so how do you choose the right ones for your financial goals? Here are some tips. Assess your risk tolerance. If you're risk-averse, stick to government or high-quality corporate bonds. If you're willing to take on more risk for higher returns, you might consider high-yield bonds. Consider the time horizon. Short-term bonds mature in a few years, while long-term bonds can take decades. Choose bonds that align with your investment timeline. Check credit ratings. Credit rating agencies like Moody's and S&P evaluate the creditworthiness of bond issuers. Higher-rated bonds are safer but offer lower returns, while lower-rated bonds come with higher risk and potential rewards. Understand interest rates. Bond prices and interest rates are inversely related. When interest rates rise, bond prices fall, and vice versa. Keep this in mind when choosing bonds, especially in a rising rate environment. Strategies for investing in bonds. Now that you understand the basics, let's talk about strategies to make the most of your bond investments. Laddering. This involves buying bonds with staggered maturity dates. As each bond matures, you reinvest the proceeds into new bonds. This strategy provides a steady income stream and reduces interest rate risk. Diversification. Don't put all your eggs in one basket. Spread your bond investments across different types, issuers, and maturity dates to minimize risk. Reinvestment. Use the interest payments from your bonds to reinvest in new ones. Over time, this compounding effect can significantly boost your returns. Monitor inflation. Inflation can erode the value of your returns, so consider including inflation-linked bonds in your portfolio to protect your purchasing power. Common myths about bonds. There are plenty of misconceptions about bonds that can discourage people from investing in them. Let's clear up a few. Bonds are only for retirees. While bonds are popular among retirees, they can benefit investors of all ages by providing stability and diversification. Bonds don't offer good returns. While it's true that bonds generally offer lower returns than stocks, their predictability and lower risk make them a valuable addition to any portfolio. All bonds are the same. As we discussed, there are many types of bonds with different risk levels, returns, and purposes. Bonds may not have the flashiness of stocks, but their stability, predictability, and income potential make them an invaluable part of any investment strategy. Whether you're just starting out or planning for retirement, bonds can help you achieve your financial goals while minimizing risk. Start exploring bond options today and take the first step towards securing your financial future. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.